Well, good afternoon, everyone. I am delighted to join you here this afternoon. A sunny day on a Saturday, so very pleased to see you all joining us for this event today. My name is Katherine Magee. I'm an investment specialist in our US equities group at JPMorgan Asset Management. And I'm here to cover the question of, can the US continue to shine bright? Because if you're anything like me, you've seen a lot of news headlines over the last couple of months. You've seen a little bit more volatility in the US stock market and a little bit more uncertainty when it comes to the new administration's policies around things like trade, immigration, potential growth opportunities ahead. And so I'm delighted to be speaking about our JPMorgan American Investment Trust, an actively managed strategy that seeks to identify a concentrated portfolio of high-quality stocks that we think can outperform the broader US market. And in today's session, I wanted to cover a few key things. First, I wanted to give you a little bit of background and a bit of an update on the US equity markets and what we're seeing in the space. Then, I wanted to highlight the benefits and attributes of the JPMorgan American Investment Trust. And thirdly, I wanted to give you some insights in terms of how we, as active asset managers, are navigating the markets and what types of companies we're investing in the portfolio. So before I do that, I thought it would be useful to take a little bit of a step back. Where were we at the start of the year, and what were our expectations for US equity markets? And to do that, I pulled up, actually, an old email that we'd written to all of our colleagues across Europe early in January saying, what is our outlook and what is our expectations for the US equity market? And we focused on four key things. First, we highlighted the economy. The US economy continued to deliver strong growth. So in 2024, the US economy grew at 2.8% GDP growth, and that's above the long-term trend of about 2% growth. Secondly, we commented on the consumer. In the US, the consumer drives about 70% of GDP growth, so seeing what the consumer is doing is incredibly important. And we were seeing a very strong US consumer. The US consumer was spending money. They were supported by a very low unemployment rate, and we'd seen that inflation had come down from peaks and was starting to stabilize. At the same time, we did say that we're seeing pockets of weakness in the lowest end consumer, and we were also seeing that consumers were being very thoughtful about where they were spending their money. They were focused on less expensive alternatives, and they were focused on value for money. Now, we are bottom-up stock pickers. We're not macroeconomists. So we also focused in on what we're seeing at the individual company level within the US. Firstly, we saw very strong earnings. In the fourth quarter of last year, companies across the S&P 500 index delivered about 15% earnings growth year on year. That's a really strong number. And importantly, we were also seeing a broadening out of the types of companies that were delivering those earnings. In 2023 and 2024, we saw a small subset of mega-cap tech names, the quote-unquote Magnificent Seven, deliver incredibly strong earnings growth, more than 30% each year. The rest of the economy, though, the other 493 companies, were closer to flat. Slightly negative earnings growth in 2023, slightly positive in 2024. But as we look out ahead into 2025, we actually expect a lot more breadth of earnings growth power. The Magnificent Seven should still continue to grow at more than 20% year-on-year earnings growth, but the rest of the market should also grow at double-digit growth, and that is great for the underlying stock market. The last thing we pointed on, though, was valuations. Because to start the year, valuations in the US market were a little bit elevated. The market was trading at about 21 and a half times earnings. That's relative to a long-term average of about 17 times. Now, there are some structural reasons for that, but it did make us very wary or cognizant of the fact that particularly in some parts of the market, we were seeing higher valuations, and so it's more important than ever to focus on bottom-up earnings. Now, what have we seen year to date? This chart shows the cumulative return of the S&P 500 index in dollars if you were to invest from the start of 2023. And in 2023, you'd be invested in the market and earn more than 25% annualized return. In 2024, the same thing happened. And actually, over that full period, you would have received more than 50% return cumulatively over those 2 years. Year to date, though, which is in the purple, we've seen a little bit of a pullback in the market. We still saw that underlying strength of the economy and strength of the consumer, but the market does not like uncertainty. And the market had started to absorb a bit more uncertainty in terms of things like trade policy coming out of the US administration and concerns potentially around inflation that may be a little bit more sticky, growth numbers that maybe won't be quite as strong, as well as some concerns around the AI boom and the significant capital expenditure that's gone into place there. So we've seen about a 10% correction throughout the year, but year to date, the market's down about 4%. We've also seen a little bit of change in leadership. So I mentioned the quote-unquote Magnificent Seven already. Hard to do a US equities presentation without mentioning them. But what you'll see on the left-hand side of this chart is cumulative growth of the Magnificent Seven in green, the S&P 500 in gray, and the other 493 companies in blue. And you'll have seen that the Magnificent Seven were driving more than half of the returns for the US market over the last 2 years, but are actually the part of the market that have sold off the most year to date. We've also seen a shift in terms of leadership. On the right-hand side at the top, you'll see year-to-date returns across different styles. So the broad S&P 500 is slightly down year-to-date, but actually value-oriented companies, think financials, some healthcare and industrials, some energy-type stocks, are actually slightly positive this year, whereas their growth-oriented peers, the more technology-oriented types of companies, have seen more negative returns. This is the exact flip of what we'd seen the previous 2 years. And if you look at cumulative returns from the bottom of the market in October 2020, actually growth had delivered the absolute strongest returns, outperforming its peers in those value-oriented sectors. All of this backdrop gives us confidence that actually, looking forward, we still see a lot of investment potential from the US equity market. But it is more important than ever to think actively about how you navigate these markets. And that's why a solution like the JPMorgan American Investment Trust can offer you a great opportunity to access these markets. Let's see if I'm getting a blank slide here. But the JPMorgan Investment Trust is an actively managed strategy. Effectively, what we're trying to do in the portfolio is identify our highest conviction stocks. We are building a concentrated portfolio of at most 40 individual companies that we think will deliver quality returns and outperform the market. We're also combining our insights from both our value-oriented portfolio managers and our growth-oriented portfolio managers. That means regardless of which cycle we're in, we can have the potential to deliver stronger returns than the market. And this strategy has done that. So this slide shows the cumulative returns of the JPMorgan American Investment Trust, or JAM, as we like to call it, over 1, 3, 5, and 10 years. The bars in blue show the returns of JAM, the American Investment Trust. And the bars in yellow and orange color show the returns of the S&P 500. And if you'd been invested in the S&P 500 over the last 10 years, you would have received a very compelling return, up 315% in sterling terms. If you'd invested in the American Investment Trust, though, your returns would have been 30% higher. And actually, JAM is one of the Association of Investment Companies' ISA Millionaires list. That means that if since 1999 you'd invested your annual ISA allowance in the JPMorgan Investment Trust, today you would have more than £1 million. Actually, you'd have nearly £2 million. And that is the power of active management and the power of compounding. Now, how does JAM achieve this? First, JAM benefits from the strength of our JPMorgan asset management investment platform. Across JPMorgan Asset Management, we run more than $760 billion of US equities. We manage this money on behalf of our clients. Those clients can be individuals, they can be wealth managers, they can be pension plans or endowments and foundations. And what you'll see here on this side of the page is that we have a very diversified book of US equities portfolios. All of these strategies are actively managed, meaning we're trying to generate outperformance relative to the market. But you'll see we invest in core portfolios. That makes up about 45% of our business, those strategies that are looking to outperform the S&P 500. We're also investing in growth-oriented portfolios. Think outperforming the Russell 1000 Growth Index or some technology-oriented portfolios. And then thirdly, about a fifth of our business are in what we call value-oriented portfolios. Think outperforming the Russell 1000 Value Index. The reason I highlight this is to just demonstrate the fact that we have a very diverse business. We know that markets can be cyclical and certain styles can go in and out of favor. But because we're investing across the spectrum of US equities, we have the ability to continue to invest and support this business regardless of which style is in or out of favor. It also means that we have a very differentiated view of the markets. Our growth investors may be thinking about companies in a very different way to how our value investors are thinking about that. And we think that's a strength for us. The American Investment Trust also benefits from our commitment and investment in research. You'll see many of our research analysts' beautiful faces here. They're a little bit small, but just wanted to highlight the fact that everything we do is based on bottom-up, fundamental, stock-specific research. Around the globe, we have more than 80 fundamental research analysts. They are based in 9 countries around the globe and speak more than 40 different languages. This gives us the insight in order to have analysts that understand the individual industries that they're investing in and identify companies that they think will be the winners for the future and hopefully avoid those that will underperform the benchmark. In order to build this specific portfolio, we've combined 2 of our investment teams together. So on the left-hand side, we have our portfolio managers from our value team. This team is focused on the value-oriented parts of the market. And importantly, they are looking to identify their highest conviction stocks, those companies that they believe to be the highest quality. We want high-quality businesses with high-quality management teams, durable franchises, a focus on strong cash flows, and importantly, a reasonable and attractive valuation. These insights are combined with those from our growth team on the right-hand side. Our growth team is also looking for high-quality businesses, but is more focused on the potential growth of the addressable market, finding those companies that they think can deliver underappreciated growth versus what the market is seeing. We think this combination gives us a really differentiated insight into the market. We're building, using the insights of these 2 teams, a high-conviction strategy. This is a concentrated portfolio, 40 large cap companies, and we also then have the flexibility to invest across styles and across the market cap spectrum, so leaning into smaller cap companies where appropriate as well. Now, to give you a flavor of how we're investing today, I wanted to share this slide. Now, this is a slightly busy slide, but one of the benefits of investing in a strategy that's high conviction in nature means that you can include every single holding, every single company that we're investing in our large cap portfolio on one page. A couple of other things you'll see here. A mix of purple and green. So the green boxes, the green names on here, are individual companies that our growth team has chosen for the portfolio. Whereas the purple companies, are those companies that are chosen by our value team. And not surprising, you'll see most of the names in our technology-oriented sectors come from our growth team, whereas those in areas like energy, real estate, and utilities comes from our value team. But they manage this portfolio holistically, they manage it together, but each of them are picking their highest conviction, high-quality names. The other thing you'll see here is across the top, we have each of the underlying 11 sectors across the S&P 500 index. Below that, you'll see the weight in the portfolio for each of those underlying sectors. And in the parentheses, you'll see our relative positioning relative to the S&P 500 benchmark. So a couple of things to call out there. On the far left-hand side, you'll see the information technology sector. We have about a 28% weight to technology in the portfolio. Not surprising, given that this is a US equity portfolio, that we have a fair amount of exposure to technology. But what you'll also see is that we're about 5% underweight relative to the S&P 500 index. That's because over the last couple of years, investors in the JPMorgan American Investment Trust have benefited from the growth of those individual technology names. And our portfolio managers have said, actually, we've seen very, very tremendously strong returns from a lot of the companies in this sector. We want to start trimming our positions and actually reinvesting that capital in other parts of the market where we haven't seen the same growth and the same heightened valuations. So coming into the year, it wasn't that we were negative on the market or negative on technology. We actually just said, relative to the benchmark, we can find interesting ideas in other sectors beyond just the technology space. And even within technology, you do see some common names in there. Microsoft, for example, NVIDIA. We are playing that AI theme through names like NVIDIA and Broadcom. But you also see other names like Analog Devices, an analog semiconductor play that provides a little bit more diversification, a little bit underloved parts of the market, or software names like HubSpot. You'll also see financials on there. Financials, of course, is a big part of the value benchmark. So lots of purple boxes there. Financials has been an area of the market that's been a little bit unloved since the great financial crisis. But actually, the fundamental qualities supporting these businesses have become much more strong. And we started to see that feed through into performance last year. Actually, the financial sector was the third best performing sector in the S&P 500 in 2024. And some of the names you can see on here that our value-oriented team has selected have outperformed. I also wanted to highlight the consumer discretionary sector. This is an overweight in our portfolio. And as I mentioned, we are still seeing the US consumers spend money. But they're being very thoughtful about where they're spending, about where they're looking to spend their money. They're spending a little bit more on things like hotels and restaurants relative to goods. And they're also being very thoughtful about value for money, looking for less expensive alternatives. So you can see a few names here. You see Booking Holdings, the travel booking website. This is tapping into that desire for spending money on things like travel and hotels. You'll also see TJX, that is TJ Maxx, or as we call it here, TK Maxx, an off-price retailer. we have a lot of conviction in some of these off-price retailers because of that desire for value for money from end consumers. And then you'll also see McDonald's at the bottom. McDonald's is a name that we've added to the portfolio recently. It's a name that obviously a lot of us are very familiar with. Again, taps into that focus on value for money. But McDonald's is a stock that actually hadn't been performing that well recently. They pushed through a lot of price increases when we saw heightened inflation out to their end customers. And actually, the market was saying McDonald's is a little bit too expensive for me. They're rethinking that model now and have started to introduce a lot of additional options. For example, what they call the $5 menu. So rethinking their underlying business, refocusing on their core consumer, and actually McDonald's is an example of a company that year to date has outperformed the S&P 500 by 10%. The last thing I wanted to mention, though, is that when investing in equity markets, time in the market is much more important than timing the market. And that's because volatility in US equity markets and across all equity markets, actually, volatility is normal. This chart goes back to 1980, and the gray bars represent the calendar year returns of the S&P 500 index in dollars. We then have the red dots, which represent the intra-year drawdowns during each of those calendar years. And what you'll see is that in most years, we do have a period of market drawdown. But also, most years deliver a positive return by the end of the year. You'll see at the top, there's a little tagline: despite average intra-year drops of 14.1%, the S&P 500 annual returns were positive in 34 of 45 years. So this is just really important and helpful to remember that volatility is a normal part of investing. It doesn't mean that the markets are necessarily going to end the year in negative territory. And actually, from our perspective, we're still relatively positive on the growth potential of the US equity market. But we think it's more important than ever to be active in how you access this market. That's why we think JAM, the JPMorgan American Investment Trust, is a great way to access this market. JAM is a high-conviction, concentrated portfolio of about 40 large-cap US stocks that also has the ability to allocate across the market cap spectrum. And it's offered in the investment trust structure that also has the ability to take advantage of things like a disciplined approach to gearing, trading at a slight discount currently, and offered at a very reasonable price. So with that, I will thank you all very much for the time today. And I will be over at the JPMorgan Asset Management stand. All of me and my colleagues are happy to take questions throughout. Thank you very much.